Welcome back to the channel. If you're new here, I'm your James Agee. This is where we analyze precious metals markets through the lens of systemic stress. Not hype, not predictions. Just data, structure, and the uncomfortable questions most channels won't ask. Before we get into today's topic, I need to cover something non-negotiable. Scam and impersonation warning. I will never message you first. I will never ask you for money, crypto, or personal information in DMs, comments, or any platform. I don't manage capital. I don't run paid groups, signal services, or private discords. If someone claiming to be me or my team contacts you asking for payment, block them immediately and report the account. These impersonators are sophisticated. They copy profile pictures, use similar usernames, and prey on community trust. Protect yourself. Verify everything. Full disclosure, I am not a financial advisor. Nothing in this video is investment advice. I'm not selling you silver. I'm not telling you to buy or sell anything. This is educational analysis for serious independent thinkers who want to understand market structure. If you're looking for price predictions, guaranteed returns, or get-rich-quick schemes, this isn't the channel for you. I encourage you to do your own research, verify every claim I make, and never risk more than you can afford to lose. Today's topic requires that same disciplined skepticism. We're examining a document that's been circulating online, a purported internal memo from JP Morgan Chase, allegedly detailing coordinated silver price manipulation tactics, specific price targets, and institutional profit strategies. The story attached to it claims this memo was accidentally attached to an SEC filing for 17 minutes before being removed. We're going to break down what's in this document, the context around it, and why the authenticity matters less than the market dynamics it describes. But I want to be crystal clear up front. This document is almost certainly fabricated. No SEC filing with such a memo has been verified. The 17 minutes detail reads like narrative fiction. The specific price targets, $71, $68, $89, are suspiciously precise for a supposedly leaked internal document. However, and this is crucial, the themes in this document are not fantasy. They're consistent with documented market behavior, regulatory settlements, and structural realities of the silver market that every serious investor must understand. JP Morgan has paid nearly $1 billion in fines for precious metals manipulation. Spoofing, placing fake orders to move prices, is not theoretical. It's admitted fact. The disconnect between paper futures markets and physical metal availability is a documented structural feature, not a conspiracy theory. So we're going to use this viral document as a framework to examine real market mechanics, while maintaining the intellectual honesty to call it what it likely is: a fabrication that accidentally tells some uncomfortable truths about how institutional players operate. If you've made it this far, if you're willing to sit through the disclaimers, the caveats, and the nuance, you're the audience this channel is built for. Drop OG in the comments so I know the algorithm is reaching the right people. While you're there, let me know where you're watching from. I want to understand our geographic footprint, because silver markets behave differently in London, Mumbai, Shanghai, and New York. The physical premiums in your location tell us something about local supply stress that the COMEX print doesn't capture. This channel filters for independent thinkers. If you need everything wrapped in excitement, emotion, and guarantees, you'll be disappointed here. We deal in probabilities, structural analysis, and the long game. Precious metals are strategic assets, national security inputs, and long-term wealth protection vehicles, not casino chips for short-term speculation. I don't care about next week's price target. I care about whether the paper pricing mechanism can survive the next 5 years of physical supply deficits. The document we're examining today claims silver is not a free market asset, but a managed tool for institutional portfolio stabilization and systemic risk control. It suggests interbank coordination, algorithmic interventions, and regulatory complicity. Whether this specific memo is real or not, these dynamics are worth understanding, because even if this particular leak is fiction, the structural realities it points to are verifiable, documented, and critical for anyone holding physical metal or paper claims to comprehend. So let's engage with this seriously, but skeptically. Verify everything I say. Check my sources. Read the CFTC reports yourself. Look up JP Morgan's settlement documents. The goal isn't to convince you of manipulation. It's to equip you to assess market structure independently, without relying on viral documents or guru narratives. Ready to dive in? Let's examine what this document claims, what we know is true, and where the truth likely sits between viral fiction and documented market reality. If the document circulating online is fabricated, and I believe it is, then why are the numbers it contains so unsettlingly plausible? Why does the market behavior it describes match patterns we've seen documented in regulatory filings, settlement agreements, and exchange data? Let me give you the specific claims, then show you the real dislocation that makes people believe them. The viral memo alleges precise price targets for silver over a 7 trading day window, $71 per ounce to trigger retail stop losses and capitulation, $68 for institutional physical accumulation, and $89 for profit realization, allegedly generating $2.3 billion in coordinated gains. It describes time selling during low liquidity periods and exploiting retail psychology via sharp drops and bearish media coordination. Now here's why this resonates. We have documented evidence of every single tactic described. The U.S. Commodity Futures Trading Commission, the primary regulator of futures markets, has publicly stated that a JP Morgan trader engaged in manipulative and deceptive conduct by placing hundreds of thousands of false sell orders in gold, silver, platinum, and palladium futures between 2008 and 2016. This wasn't speculation. This was spoofing, placing orders with no intention of executing them, creating false supply signals, then profiting from the price movements those signals triggered. The CFTC explicitly found this conduct caused market movements that would not have occurred absent spoofing orders. But the dislocation isn't just historical, it's structural and ongoing. The paper to physical disconnect is the core abnormality. Silver futures markets, primarily COMEX, trade paper contracts representing hundreds of millions of ounces daily. Yet the registered physical inventory available for delivery against those contracts has been declining for years. When paper markets price silver at $30, while physical dealers charge $35 plus, with multi-week delivery delays, that's not a free market. That's a bifurcated system where one price serves derivative settlement and another reflects actual metal scarcity. The document claims silver is not a free market asset, but a managed tool. Whether that's true as conspiracy or true as emergent structural reality depends on your frame. Consider, in 2020, the CFTC found that JP Morgan traders engaged in thousands of deceptive trading sequences across precious metals markets. The bank paid $920 million in penalties, the largest CFTC penalty ever for spoofing at the time. This wasn't rogue actors. The CFTC noted the conduct spanned 8 years and involved multiple traders, including the head of the precious metals trading desk. Now look at the current market structure. The document's claim of time selling during low liquidity periods mirrors exactly what regulators documented. Traders placing large, false orders during thin trading to maximize price impact. The exploiting retail psychology via sharp drops aligns with the CFTC's finding that spoofers profited from artificial price movements that triggered other traders' stop losses and liquidation orders. Here's the dislocation that creates fertile ground for these narratives. Why does silver remain priced in the 30s when every fundamental indicator suggests scarcity? Solar panel demand is projected to grow 170% by 2030, consuming massive silver quantities. Industrial applications from EVs to AI data centers are competing for limited supply. Mine supply growth is constrained, with major producers warning of peak silver. Above-ground investment stockpiles are being drawn down at accelerating rates. Yet the paper price, visible on every trading screen, quoted in every mainstream financial outlet, barely budges. This isn't market efficiency. This is a pricing mechanism disconnected from physical reality. The document's most alarming claim, that banks coordinate to suppress prices while accumulating physical metal, echoes patterns visible in exchange data. When silver dropped sharply in early 2021 during the Reddit-driven buying surge, we saw exchange halts, margin increases, and liquidity constraints that favored large players over retail. Whether that was conspiracy or institutional risk management depends on interpretation, but the asymmetry is documented. The why now urgency. The document suggests suppression can continue for only 8 to 12 months before shifting to scarcity pricing. This timeline is suspiciously precise for a fake document, yet it coincides with real structural pressures. COMEX registered silver inventory has declined significantly from 2020 peaks. Delivery requests have occasionally strained available supply. Asian markets, particularly Shanghai and Indian exchanges, have shown persistent premiums over Western paper prices, indicating geographic arbitrage and physical tightness. If you're a serious analyst, you must ask, why does a fabricated document feel so economically coherent? Because it describes a market structure that already exists, one where paper derivatives dominate price discovery while physical metal flows eastward at premiums that belie the spot quote. The dislocation isn't just in the silver market, it's in the credibility of the pricing mechanism itself. When the CFTC confirms that the largest bank in America manipulated prices for nearly a decade, when that bank pays nearly $1 billion in penalties but admits no wrongdoing beyond the spoofing charges, when physical markets disconnect from paper markets for months on end, you don't need a leaked memo to see the stress fractures. You just need to look at the data. The uncomfortable question this section demands: if the paper price can be influenced by deceptive conduct that regulators confirm occurred for years, why should we assume that conduct stopped with the settlement? Why should we treat the spot silver price as an objective measure of value rather than a managed reference point for derivative settlement? The document is likely fake. The structural reality it points to is not. Next, we'll examine the institutional-grade data COMEX inventories, COT reports, and delivery mechanics that reveal whether the paper market is approaching a breaking point, regardless of what any memo claims. Let's strip away the narrative and examine the structural data. Whether JP Morgan wrote that memo or an internet troll fabricated it in their basement, the market mechanics we can verify tell their own story. And it's one of increasing tension between paper claims and physical reality. COMEX registered versus eligible. The delivery stress indicator. The COMEX silver warehouse data reveals a market operating on razor-thin margins. As of January 2025, total COMEX silver inventories stand at approximately 308 million ounces. But here's the critical distinction. Only the registered category, roughly 40 to 50 million ounces, is available for immediate delivery against futures contracts. The eligible category, representing metals stored in COMEX-approved facilities but not available for delivery, has ballooned, while registered has declined. This matters because every COMEX silver futures contract represents 5,000 ounces of metal. With open interest regularly exceeding 150,000 contracts, representing 750 million ounces, the ratio of paper claims to deliverable physical metal routinely exceeds 15 to 1. During stress periods, like the February 2021 silver squeeze attempt, that ratio spiked dramatically as delivery requests surged. The viral document claims physical supply shortages outpacing demand. The data supports this directionally, but with nuance. Total COMEX silver inventories have actually increased since 2020 lows, but the composition has shifted dramatically toward eligible, long-term storage and away from registered, delivery-ready. This suggests metal is entering warehouses for storage, not for market liquidity, a pattern consistent with accumulation by long-term holders rather than active market participation. Open interest versus deliverable supply, the liquidity risk metric. The Commitment of Traders (COT) report, published weekly by the CFTC, provides the most reliable window into futures market positioning. Current COT data for silver shows commercial net position, typically short as producers hedge future output. Managed money, speculators, highly responsive to price momentum, often concentrated on one side of the market. Swap dealers, financial intermediaries, often net short as they facilitate client hedging. The critical ratio is open interest to registered inventory. When this ratio exceeds 20 to 1, the market enters a zone where even modest delivery requests could strain available supply. In recent months, this ratio has hovered near historically elevated levels, suggesting the paper market is trading on confidence rather than physical backing. The document's claim of $2.3 billion in profits from coordinated manipulation is suspiciously precise, but we can calculate what the data actually supports. A 1% move in silver prices on a $20 billion notional open interest position creates $200 million in mark-to-market changes. A 10% move, like the drop from $30 to $27 or spike to $33, creates $2 billion in position value shifts. The order of magnitude is plausible. The coordination claim is unverified. Shanghai Gold Exchange, SGE, and geographic arbitrage. The most damning evidence against pure market efficiency comes from comparing Western paper prices to Asian physical premiums. The Shanghai Gold Exchange consistently trades silver at premiums to the London COMEX benchmark, often 50 cents to $1.50 per ounce, occasionally spiking higher during supply stress. This arbitrage shouldn't persist in efficient markets. Metal should flow from low-price regions to high-price regions until equilibrium is restored. Yet the premium persists, suggesting physical metal is not as mobile as paper contracts assume. Chinese demand is absorbing available supply regardless of Western paper price signals. The spot price is increasingly a derivative settlement reference, not a physical clearing price. Indian markets tell a similar story. The Multi-Commodity Exchange, MCX, silver futures often trade at significant premiums to international benchmarks, reflecting strong domestic jewelry and investment demand that operates independently of Western futures market dynamics. CFTC Commitment of Traders, Position Concentration Risk. The COT report reveals another structural vulnerability: position concentration. A small number of commercial banks and swap dealers hold disproportionately large short positions in silver futures. While this is often characterized as market making or hedging client exposure, the concentration creates systemic risk. When the CFTC charged JP Morgan with manipulation, they documented how the bank's traders used their position size to create artificial prices and induce other market participants to trade at prices they would not have otherwise traded. The current COT data shows similar concentration patterns, though there's no evidence this concentration constitutes ongoing manipulation. The document's claim of interbank coordination is unverified, but the structural reality of concentrated short positions by a handful of major banks is public record. Whether this represents collusion or rational hedging behavior by the primary market makers is a question of interpretation. But the risk of coordinated position adjustments affecting price discovery is mathematically undeniable. Silver Institute Supply-Demand, the structural deficit. The Silver Institute's annual World Silver Survey provides the authoritative picture of physical market fundamentals. Recent data confirms industrial demand, growing consistently, with photovoltaic applications leading growth. Investment demand, volatile but trend positive, particularly in bar and coin form. Supply response, constrained by declining ore grades and lack of new primary silver mine development. The critical insight: silver supply is largely inelastic in the short term. Over 70% of silver production comes as byproduct from copper, lead, and zinc mining. Primary silver miners cannot rapidly increase output in response to price signals. This creates a market where demand shocks translate directly to inventory draws rather than supply responses. The document's 8 to 12-month timeline for scarcity pricing aligns with observable inventory drawdown rates, though the precision is suspicious. If industrial demand continues growing at current rates while investment demand remains elevated, above-ground stocks will face sustained pressure regardless of paper market price management. The paper market liquidity paradox. Here's the structural tension the data reveals. The silver market relies on futures markets for price discovery, but those futures markets are increasingly disconnected from physical settlement mechanics. When open interest represents 15 to 20x deliverable supply, The price becomes a derivative of speculative positioning and algorithmic trading, rather than physical supply-demand balance. The viral document describes algorithmic interventions and regulatory complicity. The data shows algorithms dominate short-term price action. High-frequency trading accounts for significant volume. Regulatory penalties for manipulation have been issued, confirming the behavior occurred. Yet the structural incentives for large players to influence price through positioning remain intact. Key data summary: metric, current observation, structural implication. COMEX registered inventory, 45 million ounces. Limited immediate delivery capacity. Open interest ratio, 15 to 20 to 1 versus registered high paper to physical leverage. Asian physical premiums, 50 cents to $1.50 per ounce, persistent. Geographic price bifurcation. COT, commercial position. Concentrated short position risk if covering required. Industrial demand growth. 170% solar projected by 2030. Inelastic demand pressure. The data doesn't confirm the viral memo's specific claims, but it does confirm a market structure where paper pricing dominates, physical availability is constrained, geographic arbitrage persists, and historical manipulation has been documented and penalized. Whether this constitutes managed pricing or merely stressed pricing depends on interpretation. What the data makes clear is that the price you see on your screen is increasingly disconnected from the price you'd pay to take delivery of actual metal, a dislocation that creates both risk and opportunity for market participants who understand the distinction. I want to address the technical picture briefly, not because I believe chart patterns predict the future, but because understanding market structure requires acknowledging how algorithms and systematic traders interpret price action. This isn't trading advice. It's context for why certain price levels attract attention and liquidity. Silver's weekly RSI has oscillated between 30 oversold and 70 overbought for the past 18 months, rarely breaking above 75 or below 25. This indicates a range-bound market with momentum exhaustion at extremes, a pattern consistent with institutional accumulation and distribution, rather than trending price discovery. Current RSI readings in the mid-50s suggest neutral momentum, but with a subtle bullish divergence. Price has held support levels, while RSI has made higher lows on recent tests. This typically indicates weakening selling pressure, though in manipulated or managed markets, traditional divergence signals require additional confirmation. The 200-week moving average sits near $22, representing the long-term trend that has held since the 2020 breakout. The 50-week moving average hovers around $28, providing dynamic support during pullbacks. Price currently trades between the 50-week and 20-week averages, indicating intermediate indecision. More significant than the absolute levels is how price behaves at these averages. Recent tests of the 50-week average have shown sharp, algorithmic buying responses, suggesting systematic strategies are programmed to defend these levels. Whether this represents defense of technical support or mechanical rebalancing by commodity trading advisors, CTAs, is indistinguishable from price action alone. The weekly Ichimoku chart shows price trading within the Kumo, cloud, indicating a neutral trend bias. The Tenkan-sen, conversion line, has crossed below the Kijun-sen, baseline, suggesting short-term bearish momentum, but both lines remain above the cloud, preserving the longer-term bullish structure. The Chikou span, lagging span, is approaching price from below, suggesting that historical resistance may act as current support. In silver specifically, the $26 to $28 zone represents a dense cluster of historical volume and Ichimoku equilibrium, making it a natural battleground for accumulation versus distribution. Volume profile analysis reveals significant low-volume nodes between $30 to $32 and $34 to $36, zones where price has moved quickly through without establishing dense trading interest. These become magnetic targets if momentum develops, as they represent paths of least resistance. Conversely, high-volume nodes at $28 and $32 indicate price acceptance and equilibrium. The viral document's targets of $71, $68, and $89 align suspiciously with Fibonacci extensions from the 2020-2021 move, though this could reflect either genuine institutional targeting or a fabricator's knowledge of common technical levels. Support: 2628, confluence of 50-week MA, volume profile node, Ichimoku cloud bottom. Resistance: 3234, 2021 highs, psychological round number, low volume node ceiling. Breakout targets: 3638, measured move from consolidation, 4850, 2011 resistance cluster. Momentum: neutral bullish on weekly, bearish on daily, typical of accumulation phases. Technical analysis in silver isn't about predicting prices. It's about understanding where algorithms and systematic traders will provide liquidity or initiate flows. The documented spoofing cases involve placing orders at specific technical levels to trigger stop losses and induce momentum. Knowing these levels helps you recognize potential manipulation zones versus genuine supply-demand discovery. The document's claim of time selling during low liquidity periods aligns with technical reality. Thin markets occur during Asian session opens, holiday trading, or between major option expirations. Prices are most vulnerable to positioning shifts when volume is lowest, regardless of whether those shifts are malicious manipulation or legitimate risk management. I present this technical snapshot to demonstrate market literacy, not to suggest you trade based on RSI divergences or moving average crosses. In a market with documented history of deceptive conduct affecting prices, technical indicators may reflect managed ranges rather than natural equilibrium. The technical picture suggests accumulation within a defined range, with breakout potential constrained by paper market leverage, but supported by physical market tightening. Use this as context, not prophecy. Next, we connect these data streams into the macro thesis that makes the viral document's narrative structurally plausible, even if its specifics are fabricated.